Hey Visa, Alex here. We're going to talk about Visa today, which is payment processor like Discover and American Express that I covered the last 2 days. So their current price is just under $200, which gives them a market cap of $444 billion, which is almost 10 times, no, almost 20 times of what Discover is and 4 times of American Express, which is pretty amazing. So current dividend yield is 0.61%, so not essentially a dividend stock, but the payout ratio is 19% and they keep raising the dividend, so obviously it will increase over time, but 0.61% is still not great. Revenue $23 billion, earnings $12 billion, which is up 20%, which is pretty amazing, and that gives them PE of somehow 38. Now, their stock price has been going up very rapidly recently, and it's been going up pretty much in a straight line for like years now. So they've been trading at their record high for like years almost. So forward P is 28, and the reason I used to not include that is that it's pretty much just a forecast, and it's just based on what they think it might be. So I really don't trust that, but I figured it's fair to include it. And there's obviously companies where the forward PE is more accurate, and there's companies where it's not. But I think it's good to include it anyway. Total assets, $73 billion. Total liabilities, $38 billion, which gives them a total stockholders' equity of $34 billion, and that is a pretty amazing balance sheet overall. The ratio of assets to liabilities is pretty amazing. Stockholders' equity of $34 billion is 3 times that of Discover. I think American Express was pretty much in line with that as well. But more importantly, the ratio of assets to liabilities is far better than both Discover and American Express. So obviously the market cap being this high is also great. I do think that for most investors, the price will be slightly too high, and by slightly I mean twice what it should be. If you're holding the stock for a really long time and you want to build a reasonable position in the stock, I think it still might make sense to buy it. I'm not going to, because the PE is just too high for me. The dividend yield is just too low for me. And while everything looks pretty amazing, I think all of that is priced in. And the main reason to buy the stock is the safety of principal, the dividend growth rate, and the amazing balance sheet. Beyond that, I think that it's just slightly too high priced for me. So I'm not going to buy it, but I wouldn't blame anyone else for buying it. Probably not a growth investor, because I don't see the revenue growing higher than 15-20%. I can see it slowing down quite a bit, but I think that there's still some growth potential here, especially in the rest of the world. But definitely no, 50% growth rates ever. So for that reason, I think growth investors are out. I think dividend investors can find better dividends elsewhere, especially Discover and American Express. But the dividend growth rate is amazing, and if you're going to hold the stock for literally ever, I think it might still be a good buy. And for a value investor, the PE is too high. The balance sheet is amazing though, so wouldn't blame you for buying it, but I will not. That's it for me for today. If you like this video, make sure to subscribe. I'm coming out with more videos every day before market open. I hope you have a successful day.